So we're looking forward to sharing with you today, and got a lot of stuff to go through. As a matter of fact, one of the things that I was kind of paying attention to on the big screen right over there as we were coming into today's webinar is that the Dow and the S&P closed at all-time record highs again. The S&P 500 closed at 4995.06. We were actually within an eyelash. We got up just over 4997, closing in on 5,000, which seems crazy because a year ago we were just over around 4,000, and most people didn't think we'd end the year much above or below that, and we ended up the year above 4,700, and we've continued to rise higher. So we'll talk a little bit about that, what's going on with the markets, what's going on with the economy in our webinar today that's titled The Fed from Foe to Friend, right? Like there's been a lot of people that have been really upset, concerned, frustrated about what's happened with interest rates rising so much and what it's done to the markets and the economy. Now it looks like the Fed might be poised to pivot at some point this year, and we'll talk about what that looks like and where we go. So to get started here, Nathan and I will just take a moment, introduce ourselves. For those of you who don't know me, I'm Jesse Hurst, Certified Financial Planner, Senior Wealth Manager and CEO here at Impel Wealth Management. Been doing this now for 36 years. We're coming up on our 7th anniversary here at Impel Wealth Management, and we specialize in really helping people make a successful transition from work life to a meaningful retirement. So with that, I'll turn it over to Nathan. Take a minute and introduce yourself, Nathan.
Yeah, hi, I'm Nathan Alish. I'm one of the other certified financial planners here at Impel Wealth Management and senior financial advisor. I'm coming up on my 11th year in the business and 6.5 years here at Impel Wealth Management. And you can see the rest of my bio there. But looking forward to sharing our thoughts around the Fed and the markets and what 2024 may have in store for us going forward. So
good. So we'll jump right in. I think today's session, we don't have quite as many slides today as we normally do. I think it'll probably take us maybe 25, 30 minutes to work through. We'll leave plenty of room for and plenty of time for Q&A. And just so you know, we're not allowed to use the chat button. So when you look at the, it should be like when you move your mouse over it, there should be like a toolbar at either the top or bottom of your screen. There's a Q&A button. If you click the Q&A button, you can type a question in there. Nathan's going to do the first part of the webinar. I'm going to do the second part, and then Nathan will monitor Q&A as we get ready to jump in here. So don't forget, and we'll remind you one more time before we get into Q&A at the end to throw your questions in there. But we want to make sure we have plenty of time to answer questions, as people seem to have a lot of questions about what's going on. So with today, there's 3 things we want to cover, right? The big themes. And we're going to talk about what happens if the Fed goes from raising interest rates to cutting interest rates. What happens if they go from foe to friend? Second of all, we're going to talk about the economy kind of coming into this Goldilocks soft landing scenario where the economy is slowing enough that inflation's not an issue, but not maybe heading towards recession, and whether that's really what's going to happen. And then third, we're going to talk about what might happen, what are the trigger points that might cause some volatility, and what opportunity might come from that. So with that, I'm going to turn it over to Nathan and let him start with the first 2 themes around the Fed and soft landing. So Nathan?
Yeah, thanks, Jess. Yeah, so the first theme is, obviously you can see, is talking about the Federal Reserve Bank going from being a foe to a friend. And really, if we go back to prior to 2022, March of 2022, we were in a long stretch of time where the Fed was having relatively accommodative policy where interest rates were being kept at a low point, which when interest rates are at such a low point, it's generally allows businesses, if they need to borrow money, they can do it at low interest rates to spur their business growth. As individuals, if we need to, purchase a house or have a home equity line of credit or buy a car, those were all being done at relatively low interest rates, which generally can spur, economic activity and economic growth. Well, that all changed prior the 2020 COVID pandemic, when we started to see the liquidity that was coming through both fiscal and monetary policy causing inflation to spike at levels that we hadn't seen in nearly 40 years. And with that, starting in March of 2022, the Federal Reserve Bank started to have to raise interest rates aggressively to try to slow the rate of the economy and slow the rate of inflation. And by doing so, turned more to a foe, than a friend at that point in time. So I think the question is the Fed now going to pivot and become a friend? Now, I'll say one of the things that I actually just read that I thought was interesting is the Fed has left room, technically, that they say they could still raise interest rates. However, that does not seem to be what their actual base case. Federal Reserve Chairman Powell at their December press conference really kind of indicated that they are likely done raising interest rates and will likely begin cutting in 2024. The question is when, and they have not given an indication of when that will necessarily be. The one thing I thought was interesting is, of the 19 members of the Federal Open Market Committee that actually has a say on the trajectory of the federal funds interest rate, whether it's going to go up or down, only two of those voting members has said that they believe that they will leave interest rates unchanged in 2024. Every other voting member, the 17 other members, have said that they think that there will be at least one rate cut in 2024. So I think the question is not if the Fed is going to raise rates, it's likely more of when will they cut rates. So if you want to jump to the next slide, Jess.
Yep.
So kind of what I talked through here is what bears out on the charts, which you can see, the Federal Reserve Bank, this is a historical chart looking at interest rates going all the way back to the mid-90s. And historically, rates were at much higher levels. But what you can really see there is at the bottom of the Great Financial Crisis, kind of the 08-09, is where the Federal Reserve Bank cut interest rates to zero, and rates stayed very low for a long period of time, with the Fed then starting to raise interest rates in late 2015. They actually peaked out in about October of 2018, at which point in time the market, at that point in time, Federal Reserve Bank Chairman Jay Powell and Treasury Secretary Janet Yellen talked about continuing to keep interest rates, at that point in time was a higher level than what the economy had grown used to for many periods of many years, and continuing to keep a policy restrictive. The stock market didn't like that and actually sold off nearly 20% in the fourth quarter of 2018, at which point in time interest rates started to slowly come back down. The big drop to zero was when COVID hit in February of 2020, and really with the CARES Act passing into law in March 23rd of 2020. And then, as you can see, rates were then kept at zero again until 23 months ago, in March of 2022, the Federal Reserve Bank embarked on their interest rate hiking campaign that led to the fastest hiking pace of interest rates in 40 years to try to bring down the rate of inflation. Now we're kind of at the upper end of that. And as I said, I think the real question is not, is the Fed going to cut interest rates? I think it's more of a matter of when, based off of what they have told us so far.
Yeah, and one of the things I thought was really interesting about this chart, Nathan, was when you take a look at the interest rate increase cycle here in the late 90s, heading into the Y2K and the dot-com bubble, and then when you look at the 04 to 06 interest rate increase campaign, you can see all these gradual little steps because they did a bunch of quarter point rate increases. And you compare that to the most recent rate cycle where it was a quarter point, then half a point, then three quarters. So it was not just how much they raised, but how quickly they raised that amount, which
That's
is
right.
something we haven't seen since the early 80s and in more than 40 years.
Yeah, yeah, for sure. So, well, then I think then on the next, on the next slide, this is more looking at the labor market. And I think what'll be interesting here is, the Fed has now been able to get interest rates, which peaked out at 9.1% in June of 2022. And the most recent reading on the CPI was all the way back down to 3.4%. So we've moved inflation down quite a bit. Now, so if the Fed feels like they're starting to get inflation under control, that's a good thing. And what this is showing is that in the job market, we are getting to a point of where wages, which can be a sticky component of inflation, meaning if you're an employer and you hire somebody at a certain hourly rate or salary, it's really difficult to then take that away from somebody. Once you give that wage increase, it becomes a sticky part of inflation that's hard to take back. And what this is showing is that when you look at the number of job openings versus people who are looking for work, well, if we go back here into 2022 and even early 2023, just a couple months ago or a couple years ago, excuse me, you had almost two job openings for every person looking for a job, which meant people felt like, hey, there's more jobs available than there are workers looking. So if I'm not happy with my job, with my pay, with my salary, you know what? There's another employer who's going to give me more money, and I'll leave. I'll quit my job and I'll go someplace else for a higher level of pay. And when that happens, that wage inflation has proven sticky. Well, what we can see now is that is now kind of starting to trickle back. It's not gotten back to pre-pandemic levels, as you can see here, but the trend is going the other way, where now there aren't as many job openings available as there are people looking for work. Meaning that if the job market starts to soften a little bit, that would be beneficial from an inflation standpoint, as the Fed can hopefully bring inflation back down towards its kind of stated target of 2% over time. So
Nathan, as you think about it, when there were so many jobs available compared to the number of workers, and people were very willing to switch jobs, people who switched jobs, when you think about the wage increases they got versus the people who stayed in their current jobs, what did that do to inflation?
yeah, I mean, it made inflation, spike, because you had people who could they would just jump a job and they would go get a higher wage, and the people who stuck it out and continued at their same level, well, they were here, and the other people's pay was potentially going up if they were jumping jobs and getting higher income, and the people who were staying in their current jobs, they were falling behind, which made inflation feel even more painful for those families who were being, left behind, I guess, for lack of a better term, in terms of what their wages were actually doing. So,
Yep. And it's kind of funny if you look at this chart, right? Prior to 2017, right? If you go back through history, we went through, 30, 40 years where there were always more workers available than there were jobs, which clearly put employers in control of keeping wages down.
yeah, that's
When
right.
that flipped here before COVID, right, all of a sudden it gave employees or gave workers more power to command higher wages. Everybody thought that was going to change when COVID hit, and it did. It dropped off a cliff. It dropped right back down to these same levels that we saw in the 08-09 financial crisis. But then as the economy reopened and some people didn't go back to work, and a lot of people, because of CARES Act and extended unemployment, and then you had a lot of people who just retired. I think there's about 3 million people who retired out of the job market. Those numbers shot back up to higher levels here than they were, even before COVID. So pretty weird dynamics and things. I told Nathan the other day, I said, I've done this for 36 years. And I said, in the last 4 years since COVID hit, I've said, never saw that before, more times in the last 4 years than I did in my entire previous career,
Yeah. So I think the next theme is what we talked about is if the economy is cooling, can the Fed kind of thread the needle, so to speak, and get us to engineer this soft landing? Remember, if we were to go back a year ago, one of the big concerns at that point in time was inflation was at such a high level, and the Federal Reserve Bank had raised interest rates so high as well that it was really starting to feel like it was straining potentially the economy to where we were going to potentially see the economy have a hard landing in a more severe recession. However, thus far that has not happened, and so now we have flipped, fast forward to where we are today, to where we think that there is a chance that the Fed may be able to engineer this soft landing. So let's jump to the next slide, and part of that is looking at an aging population that we've got here, or the U.S. population growth, I should say. And so when you look at this data, you go, well, the number of people that are over the age of 55 versus the 25 to 54 crowd, you have a substantial amount of population growth on the older end of the demographics here that are continuing to grow. In fact, it's 42.8 million people that are over the age of 55, which is a 75% growth, right, since 2000, whereas the 25 to 54-year-olds has only grown by 7.8 million, or 6.5%. So what that means is kind of what Jess indicated. There's help wanted signs out there where they're saying, hey, there's job openings available, but you go, well, where'd all the workers go? Well, in large part, they're 55 and older, and they've potentially retired out. So with that disparity, and a slowing population growth, it could be potential bad news for the economy. But I think that, the good news is, with challenges, there's often opportunities, that present themselves that come. So, just because we have an aging population, and to be honest, we're not the only ones, right? When you look at a lot of the developed countries in the world, that's the demographic challenge that not just us, but many developed countries in the world, where we've got an aging population base, and it's not necessarily growing on the younger side right now.
Yeah, as a matter of fact, if you look at a couple of the recent articles, blog posts we put out, one of the blog posts I wrote recently was about replacing shopping malls with nursing homes, right? And a lot of that had to do with, as the baby boomers were younger, right? We built a bunch of shopping malls and everybody went to the mall for things. Now people shop online, and, in this area, a lot of those shopping malls have been shut down or closed or torn down or repurposed into other things, and they're all being replaced with nursing homes and assisted living facilities as people get older. But the United States is still younger than most of Europe, younger than Great Britain, younger than Japan. And one of the big ones is China's a mess, right? China, if you think about it, I'm going to jump off here for just a second, right? If you think about it, China, if you think about GDP growth is a function of population growth plus productivity growth. And if you get to a scenario where your population is declining, it's really hard to have positive GDP in that scenario. Well, for 2 years in a row, China, whose population peaked at 1.3 billion people, has now seen their population decline. And there's projections out there that, just based on demographics and birth rates and so forth, that by 2100, by the end of this century, that China could see their population drop to 700-800 million people, Well, they say that China is poised to become the world's largest nursing home, and that's
Mhm.
because of having the one-child policy for 40 years. And so they have way more seniors, or they're going to have way more seniors than they have young people, and their economy is going to be upside down as a result. So, and I want to be really careful about getting into like weird political scenarios, but, you know, regardless of what your take is on immigration, right? Like I'm all for having vetted and controlled borders, but we desperately need immigration in this country because our birth rates aren't high enough to support economic growth and job growth, right?
Yeah.
And that there's nothing political about that. That's all just economics and numbers. And so, there's some really interesting challenges. And as much as what Nathan just shared about that, is an issue, and it's an issue in the United States. It's worse elsewhere. So,
Yeah, and I think, when I thought about just, from an economic or from a portfolio thing, perspective, one of the things that is historically been true is aging populations tend to favor, bonds versus stocks for the stability and the income that bonds provide versus, the potential volatility that comes with the stock market. So if we were to see a scenario where the Fed does begin cutting interest rates, well, right now, because the yields on the bond on bonds in general, it doesn't matter if it's U.S. Treasuries or corporates or municipal bonds, it doesn't really matter where you want to go in the bond market. Yields are substantially higher than where they were before the Fed started raising interest rates. So if we're earning a higher starting yield on the bond and the Fed does begin to cut interest rates, well, that's historically a good thing for bond prices, because as we know that as interest rates come down, bond pricing goes up, which would be a benefit to the aging population if they've got more of their portfolio in the bond side of the market. And I think the other key piece that's there is it goes back to what I said at the beginning. If interest rates are low, historically it's been a catalyst for growth, right? Low interest rates tends to allow for more economic growth there. So now this particular slide, looking at construction spending on new manufacturing plants, you can see the substantial surge that we have experienced just really recently here in the last 2 years. And a lot of this has to do around the fact that with the United States able to capitalize on cheaper energy prices, our ability to be more energy independent, right? The United States is not nearly as you know, dependent upon importing energy as some of our like European counterparts, for example. So the fact that we're able to have our own oil, our own cheaper natural gas allows us to potentially have manufacturing, return a lot. You've heard a lot of concepts and talks about reshoring. It used to be we offshore manufacturing. Well, now there's a big talk about reshoring it back to the United States, and that's what's evident here in this slide, where you see the amount of spending that's gone into kind of bring manufacturing back to the United States, right? So we think that we're starting to see the groundworks laid for the potential of a resurgence in U.S. manufacturing, and some of this is traditional manufacturing. Some of it is looking at bringing domestic semiconductor capacity back to the United States and battery plants and things like that. That would be a key potential driver of U.S. manufacturing going forward for our economy.
yeah. And when you think about that, Nathan, right, we've got, manufacturing coming back to the United States. You talk about reshoring. There's also this concept of nearshoring, right? One of my clients was the head of Southeast Asia operations for Goodyear Tire and Rubber. This was back in the late 90s, right? And it was really interesting at the time. They could buy materials, raw materials, ship them to China, have them manufactured in China, ship them back to the United States cheaper than it costs to build them in the United States. Well, with so many people in China over the last 20, 25 years, moving from the farms to the factories, taking higher paying jobs, China's no longer the lowest wage, country out there. So not, forget about all the geopolitical stuff and tech issues and what's going on with
Right.
Taiwan and so forth with China. China's now the seventh lowest
Right.
wage country in the in the world. Number one now is India. Number two is Mexico. So in
Yeah.
addition to reshoring onto the United States, a lot of it is nearshoring, where companies are bringing that manufacturing just back to Mexico because they'd
Yeah.
rather have it within a train ride or a truck ride than across the ocean, right?
That's
So it's
right.
been
Yeah.
really interesting to see.
Yeah.
So good, good. Anything else, Nathan, before we jump to the next slide?
No, I think we're good.
All right, so we're going to jump into, market volatility and will it provide opportunities? What could it mean? And, anytime there's volatility, up or down, there's opportunities on both sides of that we want to be paying attention to. So one of the things that we want to take a look at is valuations, right? So this chart shows a seasonally adjusted Case-Shiller. It's the cyclically adjusted price earnings ratio. PE is price earnings ratio. And what it really does is it looks at 10 years worth of earnings and adjusts it for inflation so that it takes out some of the highs and lows of economic cycles, and it gives you a longer term perspective of where stock valuations are. And you can see here in the late 90s, right, during the height of the dot-com bubble, this got as high as 44, right? And then when we went through the '08, 07, '08 financial crisis, AIG, Lehman Brothers, it dropped all the way back down in the 14, 15 range. The long-term history is right around 2021. And, there's only two ways this comes down. One is if prices come down, or the other is if earnings go up. And so now as we take a look at this, this is showing that we're elevated, but it certainly, as you can see from other time periods, it can go a lot higher. And it certainly can go higher if either interest rates come down, economic growth goes up, or corporate earnings go up. Now, in addition to this, Nathan and I spend a lot of time paying attention to what the forward price earnings ratio is over the next 12 months on just like the S&P 500. And historically, a normal range on the S&P 500 is kind of in this 15 to 17 times earnings range is what most people think is a normal valuation. You get into that 18 to 20 range, the market starts getting expensive. You get above 20, it starts getting much more expensive. If you look at the S&P 500 as a whole, as of December 31st, it was at 19.2. So it was towards the top end of that higher valuation. And one other point, just to make sure we're all on the same page with, the lower interest rates are, the higher valuations can go. So with interest rates going up so much over the last few years with the Fed, you got to pay attention to those valuations. But a lot of that valuation has been driven by 7 stocks, right? They call them the Magnificent Seven, right? It's all the tech AI driven stocks that the big names that we all know. And remember that the S&P 500 is a market cap weighted index. So the larger the company, the larger the value of the company, the bigger the weighting of the index. And right now, those top 7 companies make up about 25% of the index. Well, you take a look at that, and that means the other 493 companies make up the other 75%. So there's a second type of S&P index where instead of market cap weighting them, they equal weight all 500 companies. And when you equal weight all 500 companies, the forward price earnings ratio, instead of being 19.2, drops down to 15.9, much more in those normalized ranges, which tells us that not everything is expensive and that there are opportunities out there in other pockets of the market, right? And one of the things I think people tend to do is they tend to look to what has done well recently and go, I want to invest there. and they tend to invest after the prices on those things have gone up. And certain market strategists and economic advisors like Richard Bernstein's group always says, let's look for what didn't do well. Let's look for the unloved, undercapitalized things, and let's invest when prices are low. So when you start taking a look at this, right, we've got the 12-month valuation gap on price earnings ratio, right? You take a look at this, and this shows large company price earnings ratio. There it was at that 19.2. And then this shows small companies. Small companies over the last couple of years. Nathan, what was the statistic that you shared the other day with the S&P 500 companies being at all-time highs, but small cap valuations are
Yeah, small caps, they basically peaked out in from a price standpoint. The peak on the small cap market was all the way back in February of 2021, and since then it is still nearly 20% below its all-time high. So that's the disparity, right? Where the S&P 500 is closed at an all-time high today, whereas small company stocks are still technically right on the brink of a bear market,
Yeah.
So.
Yeah, and you take a look at this and you can see all through 08, 09, all through the mid-teens and so forth, right up to 2017, right, that they tracked each other pretty closely. And you take a look at the disparity between them, what that tells us is, and I saw one other statistic that I thought was pretty interesting. The 500 companies that make up the S&P 500 today have a total valuation of about $41 trillion. The 2,000 companies that make up the Russell 2000 have a total valuation of $2.5 trillion. It's only 6% of the S&P 500. That's the lowest it's been in 15 years. And this valuation gap says, hey, maybe instead of putting all my money in large cap that's done well recently, maybe I should be looking at some small cap opportunities, because the disparity leads to the opportunity to buy low rather than buy high. So the other thing we wanted to remind people is volatility is different than risk, right? Risk is permanent loss of capital. Volatility is just swings in your valuation, right? And if you take a look at this chart, I know we've probably shared this with you before, but from 1980 through 2022, the market on an average year has dropped 13% intra-year. So the way you read this chart is all of these bars tell you what the stock market did in that year. So we can go back here and say, okay, in this particular year, the stock market went up 37.6%, and the biggest drop in the market that year was 2.5%. But, we can take a look at a year like last year where the stock market, where the stock market was up. Well, this was actually a couple of years ago, because this chart's a little dated. This is 21, right? It was up 28.7, and the market dropped, 5.2%. But you can also see lots of years where the stock market had double-digit losses, where within that 12-month period of time from January to December, the stock market dropped 12.1% or 19.3 or 10.8%. And all three of those years, the market ended up high double digits. So there was volatility intra-year within the market. But if you stayed invested through that entire time period, the market averaged 12.9%, even though the typical year, the market dropped 14.3% on average. So I put out a blog post. Oh, I actually haven't put out a blog post. I wrote a blog post. It'll be coming out in the next week or two, called "Everybody Loves a Sale." And it talks about, as Americans, we love to buy everything we buy on sale, except for our financial assets, right? When the stock market goes through a downturn, everybody freaks out and wants to sell. And you can see, even in a year like here, where the stock market dropped 19%, and for the year it was down 3%, if you sold at that point, you missed the 30% rebound the next year, right? So one of the things that Warren Buffett says, and I always say Warren Buffett's like the most admired, least emulated investor out there, is that, hey, if you were, I'll pop off here for just a second, right? If you were a baker, right, and you owned a bakery and you had to buy flour every day to make your baked goods, and the price of flour went on sale for 20% off, what would you do? You'd back up the truck and buy all you could while prices were low. And Americans tend to do that with everything they buy except their financial assets, right? And one of the things that Nathan and I have been trying to talk with clients about is you should learn to love a sale, and especially if you're young and in the accumulation phase of life, right? When the stock market goes through a downturn, don't look at the value of your 401k. Think about how many shares you're buying when things are down and prices are cheap. That's where you get the biggest valuation benefit down the road. So don't think that volatility and risk are necessarily one and the same thing. Last couple things here, and then we're going to jump into Q&A. I think I've got 2 more slides, and then we're going to jump into Q&A, right? One is interest rates are higher today on bonds, and Nathan alluded to this earlier, than we've seen in years, right? And real interest rates is the interest rate you earn on bonds minus the inflation rate. So right now, on a lot of bonds that we're seeing out there, a lot of AA, single A corporate bonds, a lot of mortgage bonds, and so on, and even short-term treasuries, we're seeing yields of 5 to 6%, sometimes even a little higher than that. And if inflation has dropped back down into that 3.5% range, we're now earning yields of 2 to 2.5% positive, meaning that we're getting 5.5% yield, take out 3.5%, inflation, and we're getting higher yields today than we've seen at any time in the last 15, 18 years. And one of the things that bond managers will tell you is that the starting yield on your bond portfolio is the best predictor of whether you're going to have positive returns going forward. So, and remember this, right? Nathan and I have talked about this a ton, is this teeter-totter, right? When interest rates the last 2 years went up a bunch, bond prices went down. Well, now we're in the different scenario, because Nathan talked about the Fed's potentially going to start cutting interest rates. So when interest rates go down, bond prices go up. And if you're earning yields of 5 to 6%, and then the Fed cuts rates, you get the 5 to 6% yield plus the appreciation on the bonds. So as bad, right? One of the other analogies that Nathan and I talk about a lot is managing an investment portfolio is like driving a car. And if you look at how poorly bonds did the last couple of years as interest rates went up, that's all in the rearview mirror. That's what did happen. If we look through the windshield of what's coming with higher yields and the Fed cutting rates, it gives us an opportunity set in bonds that we haven't seen in 15, 18, 20 years. The other thing I wanted just to quickly address was geopolitical risk, right? Because we're sitting here with war in the Middle East. We're sitting here with war in Eastern Europe between Russia and Ukraine. And a lot of times people think, oh my gosh, that's going to be horrible for the markets. And a lot of times the initial event is, right? If you look at 1 day, 3 day, 5 days afterwards, you can sometimes see a pretty big drop in the market. But most of the time, if you go out 1 month, you go out a year later, the markets have recovered remarkably well. And a lot of times that's because of the economic boost from the military industrial complex and ramping up for war, or even in the case, like I remember, when 9/11 happened, right? The market dropped a bunch right away, but then immediately people started talking about what's it going to take to rebuild New York City? What do we have to do to rebuild phone lines and telephone lines and computer infrastructure and buildings? The big reason the market was down after 9/11 a year later wasn't because of the 9/11 attack. It was because of the dot-com bubble and the unraveling of the internet bubble that happened as a result. And I think one of the things that we have to remember is when you're investing in the market, a lot of times people think, oh, I'm investing in the S&P 500, I'm investing in an index. It's not just investing in an index, you're investing in 500 of the largest, most profitable companies in the United States. And these companies have CEOs whose job it is to innovate, sell, and create profit. And they've learned to do it whether interest rates are going up or down, or the economy's slowing or growing, so it's, don't think that, a geopolitical event in and of itself will cause the markets to fall. We have to focus on corporate sales, corporate profits, and what that does to stock prices over time. So with that, I want to, by the way, throw in again, whether you click the Q&A button at the top or bottom, type in your questions. We'll take a couple minutes here if we have some questions to answer those, right? I want to remind you that, first of all, I think one of the things that's most important is, as the economy has gotten better, as inflation has come down, as corporate profits have started to rebound, Liz Ann Sonders, who's one of our favorite economists over at Charles Schwab, talks a lot about the fact that it's not the absolute level of inflation or the absolute level of profits that drives things. It's whether it's getting better or worse. If things are getting better, then that will drive optimism and so forth for the future. I did also want to address the fact that at the December Fed meeting, so the Fed meets 8 times a year. So it's like they meet typically every 6-7 weeks. It's not an every month event, but 8 times a year the Fed meets. 4 of those times they put out economic projections, and when they put out those economic projections, it tells what the Fed governors project will happen with GDP growth, inflation, unemployment, and whether the Fed will raise or lower interest rates. So those economic projections came out in December, and they were projecting that the Fed thought that they would cut interest rates 3 times in 2024, and that's what the market got all excited about. The market has a Fed futures betting market almost, right? That is projecting that the Fed's going to actually cut rates 6 times. Well, if the Fed's telling us 3 and economic data is coming in better than expected, maybe it's 2, maybe it's 3. For those of you who know, you probably don't because you'd have to be an economic geek like me or Nathan to know this, but one of the Fed governors is a guy by the name of Neel Kashkari. He's the Federal Reserve Bank president of Minneapolis. He was on CNBC this morning. And for those of you who don't know, Neel Kashkari grew up in Stowe, Ohio, went to Western Reserve Academy. So that's one of our claims to fame here in Northeast Ohio, is we have a Fed president that grew up as a local guy. But he was saying maybe the Fed will cut 2 times, maybe they'll cut 3 times. But if the market's betting 6 and the Fed's telling us 2 or 3, somebody's wrong, and that could create volatility. Volatility, again, is temporary. It doesn't mean you should change something just because of a temporary blip in the markets. And a lot of people go, well, wouldn't it be great if the Fed cut rates 6, 7, 8 times? And I remind people, be careful what you ask for, because if the Fed has to start cutting rates aggressively, it probably means that the economy's slowing and unemployment's going up way faster than they thought it was. So, maybe the Fed only having to cut rates 2 or 3 times because economic growth and profits remain strong without having significant damage to the economy might not be too bad of a thing. So remember, right, we think there's more evidence of a soft landing. We'll see. There's still a fair number of economists out there. Brian Westbury from First Trust, the group of people over at PIMCO. There's one other big one that I know that's out there, that their base case, Jeff Gunlock over at DoubleLine. Base case, they still think we have a mild recession sometime mid-year, later half of this year. They don't think the economy is going to fall off a cliff. But as much as everybody, remember this, right? At the beginning of 2023, 80% of all economists thought we'd be in a recession at some point in 2023, and it didn't happen. Now most economists think we'll be in a soft landing scenario, and we don't know who's right. We just have to be prepared to respond based on what's going on and what helps you meet your financial goals and objectives. So with that, we're at about 45 minutes. Nathan, any Q&A that we want to share?
Yeah,
Talk about.
right now we've got two. So let's tackle the first one. The first one is discuss our thoughts on the housing market, in particular pricing staying relatively elevated through 2023 and still here in 2024.
Yeah, that's a really interesting one because the housing market has thrown people for a loop, right? If you went back to 2020, right? If we went back 4 years ago, since that time, the average housing price has gone up 35 to 40%. And a lot of that just has to do with supply demand dynamics because you bought Nathan, when did you and Lauren buy your house?
October of 2020.
Right? So, and your mortgage interest rate is
2.75%.
right? So anybody who bought a house between 2010 and 2021 probably has a mortgage rate, if they have a mortgage, right? They have a mortgage rate of somewhere 3.5%, 3% or less. And as the Fed raised rates and mortgage rates went from 3 to 8, today they're just above 7. Most people don't want to get out of a 3.5% mortgage and go to a 7.5% mortgage. So therefore, there was less inventory on the market. Everybody that wanted to buy when homes came on the market, you had bidders competing against each other, which kept raising prices. So if you go back and you look at, let's say, a $300,000 house in January of 20, and today that house is valued at 400 or 420, right? Buying a $300,000 house at a 3% mortgage versus buying a $420,000 house at a 7% mortgage. For young people today, the mortgage payment differential is almost 90% higher in just 4 years. Now, just to finish, because I know you and I could talk about this for a long time, but most economists feel that if you see mortgage rates drop back down into the 5% range, 5.5, below 6, that all of a sudden people who have been hesitant to sell will start putting inventory back on the market. And that could actually help home prices if you had more inventory and fewer people competing for that, for the few homes that were on the market at that point in time. So we think there's likely to be some movement as interest rates start to come back down.
Great. And I think the second question is more around the idea of talk about a presidential election year with us being 9 months out from the election, and what does that normally historically maybe look like?
Well, and this kind of goes back, it's a great question, right? And it kind of goes back to what we talked about before. What happens, what drives the stock market over time is corporate sales, corporate earnings, and profitability, not who's in the White House or who's in Congress. Now, regulatory environment or tax law may come into play, but if you look at it in our investment committee report from last month, from January, we put a chart in there that showed since 1935, the S&P 500 under Democratic presidents had averaged just over 11% a year, and under Republican presidents had averaged just under 11% a year. And the only thing that really skewed it a little bit was that W managed to grab both the dot-com bubble and the 2008 financial crisis, and that dragged the Republican down. But they were very similar. So what it tells us is, as much as we obsess over the political side of things, it really doesn't drive the economy, companies, profits, and markets as much as we would think. I do think one thing we're going to have to pay attention to, I got two thoughts here. So let me get this one first. The one thing I think we are going to have to pay attention to is the tax law that's in place today, the Tax Cuts and Jobs Act, that went into effect January 1 of 18 did not get a super majority. So it expires at the end of 2025, at the end of next year. That means that who's ever in control of the White House and Congress after the 2024 elections will be in the driver's seat to drive new tax law. And with, you think about in 2017, when the Tax Cuts and Jobs Act was first passed, we were at about 20 trillion of federal debt. Today, we're at about 34 trillion. I don't see tax rates going lower in the near future.
Yep.
So I think we will have to pay attention to that. The other thing I think is if you look at presidential and congressional election years, markets tend to be somewhat flat and volatile in the first 8-9 months of the year. And then towards the latter half of October and through November, December, as the markets get clarity on who's going to win and they know how to respond one way or the other, it doesn't really matter whether it's Democrat or Republican, markets tend to do well unless there's some weird geopolitical event at that time. So
that removal of the uncertainty,
Right. Yeah, you remove the uncertainty. We know who's going to be president. Then companies can know, or they know who's going to control Congress. Then they can know how to move forward. So great question. Anything else today, Nathan?
Those are the questions that we have. So.
Okay, so good. Well, listen, we want to thank everybody for coming, right? We always enjoy getting a chance to share with you. When we have 25, 30, 40 clients that get to see these events, right? That's 25, 30 people that aren't calling in and asking the same question. So we're always happy to get a chance to share. Remember, we're here to help you. We provide our blog posts and financial planning and our portfolio advice and so forth. And we're not here just for you. If you have friends, relatives, people that aren't getting this kind of help and advice from from the people they work with, and they're looking for a trusted advisor relationship, we're here for them as well. So with that, we're going to close. Please feel free, email us, call us, let us know if there's anything you need. And thanks. We hope you have a wonderful day, and thanks for sharing part of it with us. Bye-bye.
Take care.